Welcome back to the Deep Dive. Today we're moving past the ledger sheets and jumping straight into the moral compass of money management. Specifically, we're focusing on tax planning, a topic that seems purely technical, but is, at its heart, profoundly ethical. Our mission in this deep dive is to extract the essential ethical foundations that underpin all responsible financial advice, especially when we're dealing with tax strategy.
Right.
We want to know the standards, the expectations that ensure the planning remains fair, compliant, and always centered on your best interest. It's about separating the technical rules from the professional integrity you need to apply them.
That's the critical distinction, isn't it? You can know the tax code inside and out, but the moment you start applying that knowledge for a client, you are making ethical judgments.
Yeah.
The client is paying for accuracy, yes, but they rely on integrity, on transparency, and I think a balanced application of the rules. Our source material makes it really clear. Without a strong ethical standard, even advice that is technically compliant can still harm a client's long-term financial health, or even their reputation.
So we're really defining ethics here as something like doing what is right, not just what is allowed.
Exactly.
This means financial advisors have to look beyond the letter of the law and deeply consider concepts like fairness, suitability, and, well, long-term client well-being. It's an exercise in professional judgment. Let's start with the most obvious ethical friction point then, drawing the line. Because the moment we talk about minimizing tax, we're immediately standing on a boundary. This is where ethics become crucial in distinguishing acceptable planning from, say, unacceptable aggressive avoidance.
We absolutely need clarity here, and the sources categorize the continuum pretty well. First, you've got tax evasion.
The easy one.
The easy one, right. That is clearly and unambiguously illegal, deliberately concealing income, falsifying documents, that sort of thing. It's outside the professional scope entirely. The sticky area is the second category, tax avoidance. This is where you're exploiting legal loopholes or using structures that are, well, they're artificial. They're primarily designed to reduce tax without any real commercial purpose.
And while that's technically legal.
Technically legal, yes, but the source material, reflecting the view of organizations like HMRC and the broader financial services profession, views aggressive avoidance as unethical and potentially harmful.
Okay, that's the gray area, legal but professionally condemned.
Yep.
Why is that? I mean, if it's technically allowed by law, why does the profession itself deem it unethical?
It's because of the risk and the intent. Aggressive avoidance, it often relies on these convoluted structures that are specifically targeted by future legislation or regulatory challenges.
So you're setting the client up for a future problem.
Precisely. An ethical advisor understands that putting a client into a scheme that invites scrutiny, potential legal costs, long-term stress, or reputational damage just for a marginal short-term gain. That's a failure of duty. It prioritizes the scheme's complexity over the client's stability.
And that leads us to the third and the ethically sound standard, tax planning.
Exactly. This is where the advisor focuses purely on using legitimate allowances, reliefs, and standard tax-efficient products. Things like ISAs, pensions, or standard capital gains reliefs, precisely as Parliament intended.
You're using the system, not gaming it.
You're making smart, sensible use of the system designed for the general public, not trying to find legislative gaps to exploit.
And as our sources stress, these ethical standards aren't voluntary, are they? They're built right into the UK regulatory infrastructure.
Absolutely not.
The Financial Conduct Authority, the FCA, mandates that advisors must act with integrity, exercise due skill, treat customers fairly, and actively avoid conflicts. These requirements directly dictate how suitability is judged in tax strategy. So you can't just recommend a strategy because it minimizes tax. You have to prove it's fair and appropriate under those core ethical duties.
The ethical standard truly informs the suitability standard. It means asking, is this the least risky, most efficient way to achieve my client's goal, or is it just overly complex and reliant on fine print?
That takes us neatly into the practical ethical challenges, especially around complexity and communication. Because tax law is notoriously dense, it places a massive ethical requirement on the advisor regarding client understanding.
This is a huge responsibility, a huge one, The ethical burden is entirely on the advisor to translate that complexity. It is fundamentally unethical to recommend strategies if the client can't reasonably grasp the mechanics,
Or if the risks are downplayed.
or if the advisor downplays the risks, the associated costs, or the long-term consequences, like locking away capital for decades. Clear, proactive communication isn't just good service, it is central to informed consent.
Let's explore that difficulty with complexity a bit more. Our sources mention specific tools, offshore bonds, discretionary trusts, sophisticated business relief structures. For those who might not deal with these daily, what is it about these instruments that makes them such fertile ground for ethical challenges?
Well, these structures are powerful because they allow for significant asset movement, often across generations or borders, and they provide a lot of flexibility in how income or capital is distributed. The ethical challenge comes in because their complexity can so easily obscure the true costs or the restrictive terms.
How so?
For example, a discretionary trust grants immense power to the trustees, which the client might not fully appreciate at the outset. The advisor must ensure the recommendation is proportionate. Is the complication and the cost of setting up this complex structure truly justified by the tax saving, or is it just overkill?
And the sources emphasize that complexity should never be used for its own sake, or worse, be driven by the advisor's self-interest.
Absolutely. Which brings us to the biggest ethical minefield of all, conflicts of interest. This isn't just about disclosure, it's about elimination where possible.
Right.
If an advisor stands to gain a higher fee or some product incentive from recommending a complex offshore bond over a much simpler ISA or pension wrapper, that personal gain must never be the primary driver.
So how does an ethical advisor practically navigate that fee landscape when they're recommending a tax-efficient product?
Transparency is paramount. They have to clearly justify why that specific product or strategy, whether it's a pension contribution, a trust arrangement, or a particular investment, is suitable. And they must clearly outline all the associated charges in their own remuneration.
So it's about proving the value.
It's about proving the product is the best available fit for the client's goals, not the best available fit for the advisor's commission structure. The client's best interest has to be demonstrably paramount in that suitability report.
If we pivot now to accountability, the ethical framework isn't solely about honesty. It's also about professional competence and limits. An ethical advisor has to know when to say, I don't know, but I know someone who does.
This is such a critical risk mitigation step for client protection. Advisors must recognize and respect the boundaries of their own expertise. You just cannot ethically provide advice in areas where you lack sufficient knowledge. We see this all the time when dealing with highly specialized areas.
Can you give us an example, a situation where an ethical advisor must immediately involve a specialist?
Oh, easily. Think about complex trust taxation, or intricate corporate restructuring for business owners, or cross-border tax issues for non-domiciled individuals.
Okay, very specific stuff.
Very specific, and the tax implications in those scenarios are so specialized and prone to constant regulatory change that internal guesswork is just dangerous. The only ethical course of action is collaboration, bringing in external chartered accountants, specialized solicitors, or specific tax experts to ensure the advice is compliant and holistic.
It's due diligence, not outsourcing.
Exactly. It's about ensuring the client benefits from multidisciplinary expertise.
Now, since tax advice requires an incredible amount of personal data, income statements, asset valuations, family dynamics, sometimes even medical history, the related ethics of data protection and confidentiality become deeply serious.
They are completely non-negotiable. Ethical practice demands that this detailed personal data is stored securely, accessed only by those who absolutely need it, and strictly protected. Confidentiality has to be maintained.
Always.
While the only exception the source material specifies for disclosure is when it is legally mandated, such as obligations under anti-money laundering regulations or when tax evasion is suspected.
And running parallel to that is the requirement for documentation. Record keeping often sounds like a bureaucratic chore, but our sources frame it as a deep ethical imperative.
It is the proof. It's the proof of the ethical decision-making process. Advisors have to meticulously document every single recommendation, every suitability assessment, the tax assumptions they used, and the reasons for the client's final decision.
And that's not just for their own protection.
No, not at all. These accurate records are vital for transparency, for protecting the client if they face an inquiry, and for accountability. If HMRC decides to review a pension contribution or a complex transfer years later, those records provide the necessary evidence that the advice was sound at the time it was given.
Let's move to Section 4, which is perhaps the most nuanced part of the job.
Yeah.
Balancing tax savings with the client's actual long-term financial welfare.
Mm.
Clients often come in focused solely on minimizing their tax bill, sometimes, blind to the consequences.
This creates a direct ethical tension. The advisor has the responsibility to guide the client toward balanced decisions. Ethical planning fundamentally rejects strategies that might seriously jeopardize a client's liquidity, or expose them to unnecessary investment risk, or undermine their retirement security just to save a few percent in tax today.
The focus has to be bigger.
The focus must always be on promoting comprehensive, long-term financial stability.
The inheritance tax planning case study from the sources highlights this beautifully. Reducing IHT is a huge motivator for so many people, but if the client gifts away a substantial part of their liquid assets to save future tax, they might compromise their ability to pay for long-term care or essential living expenses down the line.
Absolutely. The ethical advisor ensures that tax efficiency is balanced against client welfare and sustainability. The discussion has to revolve around, what is your comfortable minimum retained capital? You cannot, ethically, advise a client to gift away assets that they might foreseeably need themselves.
The person in front of you is the priority.
The long-term security of that individual always takes precedence over the tax savings for their beneficiaries.
There's also an ethical dimension to fairness when advising couples or families, isn't there?
Yes, because tax planning often involves rebalancing assets between partners. For example, transferring assets to a lower-earning partner to maximize tax allowances. This is a perfectly legitimate strategy. But the advisor must ensure that both individuals fully understand the legal and financial implications, particularly around control of those assets. Ethical practice requires respect for informed consent and a clear understanding of the financial power dynamics within the relationship. It's about making sure both partners are equally comfortable with the strategic changes.
So if the regulatory environment is constantly shifting and tax law never stands still, that means our deep dive has to conclude with a necessity of continual improvement.
Precisely. Given how frequently tax rules change, sometimes annually, sometimes mid-year, relying on outdated knowledge is, frankly, a failure of ethical duty. Advisors have to prioritize continual professional development, actively seeking out training, consuming guidance from professional bodies, and just staying current.
Technical competence is an ethical issue.
It has to be. Accuracy is a foundational component of ethical advice.
So, to bring everything together, it seems we've extracted these core principles. Ethical tax planning demands integrity, clear communication that ensures client comprehension, rigorous avoidance of conflicts of interest, and a consistent focus on the client's long-term financial stability over any aggressive short-term tax advantage.
Ultimately, this ethical framework is what professional credibility is built upon. It's the difference between a transactional relationship and a trust-based one, which is the only way to genuinely deliver that financial peace of mind every client is looking for.
That leaves us with the challenging standard we identified early on, doesn't it? If aggressive tax avoidance is technically legal, yet professionally and ethically deemed harmful and unacceptable by the industry and its regulators, what broader implications does that set for competence and judgment? It demands that financial professionals exert a level of personal judgment that far exceeds merely ticking regulatory boxes. It requires them to predict the future risk of legal change and reputation damage. Thank you for joining us for this deep dive into the demanding ethical requirements of tax planning. We hope this exploration provides you with a clearer understanding of the high standard of judgment required from those who manage your money. We'll see you next time.